Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.
Hello, I'm Michelle Makori coming to you from the 49th New Orleans Investment Conference. This is one of the longest running gatherings of investors coming from all 50 states and 35 nations. And my next two guests are veterans of this prestigious conference, and they are saying that we are on the brink of a new megatrend, a new era of rising debt and rising interest rates, and that investors need to prepare. Pamela and Marianne Aden are the editors of the Aden Forecast. It's really great to have you with us, ladies. Thanks for joining us.
Well, thank you. It's a pleasure to be here.
All right, so Pamela, let's start with you, and let's start off with the big macro picture. Mm-hmm. And you're saying that we are on the cusp of a new mega trend that we haven't seen for 40 years. Break that down.
Okay. It has to do with interest rates. And they are the most important market, whether people realize it or not. It is the most important market that affects all the other markets. It can be stocks, bonds, metals, economies, world markets. It affects everything. And what had happened this past year in this soaring rise, the biggest rise, the Fed has made the Fed funds rate go from 0 to 5% in a whiz. It was head spinning for many, and for many bankers, many hedge fund managers, and many people in the business were shocked about it, were surprised at the rise it had. But really, the Fed funds rate is not the leader. That's what's interesting. The T-bill rate actually kind of dictates, because the free market, what the Fed funds is going to do next in their next meeting. It seems to work that way. But anyway, the point is that this rise this past year has made a significant change in what has been going on for the last 40 years. 40 years we have seen since 1980 till 2020. We just saw 40 years of down interest rates. That was just a steady downtrend. One thing with interest rates, they don't change often. But when they do, it's a big deal, very big deal. And that's what happened this past year. So this is why we said a megatrend has changed. Interest rates have changed to the upside. And I want to add one more thing, is that from 2008 to 2020 until now, things have never been the same. And people, they talked about zero interest rate policy back in the day, and that seemed normal. It seemed normal because it was last so long, and it's not normal. It wasn't normal. It was abnormal. And now we're going back to sort of a normality, and we think that from here on out, aside from some pausing that like the Fed did today, they'll probably do that for several more months, kind of calm things down. But we think the trend is up now for all the interest rates, short and the long end.
All right, we're going to get to what you think we can expect from the Fed next, but let's expand on this idea a little bit more, Marianne, because this also comes, as Pamela said, we have interest rates at 22-year highs. We went up to 5.25%, 5.5% in about 18 months, just over a year and a half, this dramatic ascent. And Marianne, it also comes at a time where we have tremendous deficits, right? According to the latest data, U.S. federal deficit is on course to double this fiscal year compared to last year, rising from $1 trillion in 2022 to $2 trillion in fiscal 2023.
I know. And unfortunately, it looks like it's going to keep rising because interestingly enough, the year 2020 was the year where the Fed or the government spent the most money. They had the biggest spending spree because of COVID and what have you. This year is the second biggest. And really the only thing that's different aside from the normal expenses the government makes is that interest rates have gone up, like you said, from 0 to 5.5. And that is really increasing the interest payments that the government has to make. And if interest rates keep rising because of this mega trend, then we're going to have deficits that just keep doubling and doubling. And so that's something that's a big concern. Right now, interest payments are already equal to what the government spends on defense, for example. And that's supposed, by next year, the year after, it's going to be far greater, one of the greatest government expenses. And that is going to balloon those deficits to the moon, practically.
Yeah, servicing that debt is becoming a really, really big concern. Pamela, you have been focusing, as much of the markets have been, on the 10-year yield as well as the 30-year yield, because recently 10-year yield breached 5%. As a reminder, yields go up when prices go down, so that signals less demand for U.S. Treasuries to have a rising rate. It pulled back a little bit when we heard from the Fed that they're pausing at this meeting. But what is the bond market telling us? Why is it so important to be paying attention to the 10-year and the 30-year?
Oh, it's vital to be watching it right now, because the fact that it shot up as the way it did, short rates as well, they all shot up. Now they're due for some sort of downward correction, a pause, a quiet period. And this is what the Fed is suggesting about leaving rates unchanged. So that 5% seemed to be like that's the tip, that's the top for now. But the 10-year and the 30-year move in lockstep. They're very close together. We use a 30-year because it's the longest dated issued by the federal government, but the 10-year is the most popular one. But either way, they're the same. And this is saying that if it goes down to 4%, 3.5% right now during a correction, it still doesn't change the fact that a mega trend has changed. And it's going up, and it's just starting.
So you're not seeing any pullback anytime soon in terms of interest rates. I mean, we had Fed Chair Jerome Powell, signaling that they've paused again. Markets are pretty much expecting another pause come December. But you think that the Fed is going to stop but hold at this rate?
Well, it seems to me that it's time for some quiet time, because everyone is so upset about this rising rate. The rates just went wild, and the Fed knows that. So they want to just calm things down. So yes, a downward correction would be totally normal now. Say that from the 5% it hit, so 30-year went a little above a 5, and they come down to even under 3%. You're still going to see, and that's quite a correction.
So even if they start cutting dramatically to 3%, is what you're saying?
Well, not necessarily. It can just float down. The thing is it looks like it's just going to be some time out. And the Fed will have it seems like it would be to advantage of the Fed. Then they don't know if they're going to raise rates yet or not, but the market tells us they're going to raise rates. But maybe it's next year. Like it could be months away from now before you see another rise in rates.
So you do expect another rise in rates. You do not think the Fed is done?
No, not at all. We think they've just begun.
The Fed has just begun, Marianne. I mean, we've been saying they're going to raise until something breaks. Things look like they're pretty much on breaking point. Do you think there's more room for the Fed to continue raising?
And that's why Pam said they're due to cool down, come down a bit, and that could last for months. And because the mega trend, you have to remember, lasts for decades. I mean, so it's not something that's going to be, next month. They could calm down because they've gone too far, but then eventually, probably next year, rates will start up again. We can't tell you why, but you can assume it would probably be because inflation is heating up, or some forecast, a recession. We just don't know what is going to be the trigger. But rates will start up again next year.
Well, many in the markets are expecting the Fed to cut. Now, granted, these people have been quite wrong so far, because nobody really thought the Fed would have the gumption to go this high this quickly. But the sentiment is that this tightening is going to really start to show itself in the markets, in the economy, and that the Fed is going to be forced into a pivot by, say, mid-2024. Do you see that? Because it sounds like you don't.
Mm-hmm. Well, you know what it is.
So no pivot. You don't see a rate cut to 20.
Well, it's not the Fed's decision to have that. That's the whole thing. They go with what the market is telling him. Like telling Jerome Powell, the market moves, and he tries to accommodate as best possible.
Well, technically, they should not be watching the stock market, right?
Well, not the stock market. They're watching the interest rate market, if anything else, and bonds. That's what they're watching to make their decisions. So if you see that, so that's why it's really not him as a person or an entity.
It's not him, but it's the committee, right? It's the FOMC.
No, I don't mean even the committee. I mean, it's gone beyond them.
So what would make them hike again?
Well, inflation could make them hike again, and we certainly have inflation that's not easy. That's not easy to take that away, and so that's their fight, to fight inflation. So they can fight it all the way up, And so inflation is here for a while. It's not a fleeting thing. And like many people were waiting for it to be temporary, we don't think it's going to be temporary. We think we're having another 1970s on our hands for the first time ever. Since the 1970s, this is the first time 1970s looking very familiar to today's world. And
right. I mean, inflation, last reading for core inflation was up 3.7% year over year. And I always like to emphasize, Marianne, that this is the growth of inflation, right? It's only grown further year over year by 3.7%. So even if we get inflation down to 2%, that still means prices are increasing by 2% from where we left off in 2020 when we started to see this dramatic increase. So if the Fed continues to have this fight against inflation, the thinking is that it may need to give up that fight in the face of other factors. For example, flaring geopolitical tensions, right? There's so much uncertainty in the world, and servicing this debt, which we just discussed. So what's going to win out? In your opinion, you think inflation wins out over these other concerns?
Probably. But again, that we're just, making an educated guess, because it could be any number of factors. And we're talking, next year, the year after, we're talking longer term. So it could be any number of things.
Let's talk a little bit more about this debt servicing, because this really is such a big deal. It's a very big concern. The latest to really hone in on it is Jeff Gundlach. He's the CEO of DoubleLine, has about $140 billion of assets under management. And he's saying recently that even if we stay where we are, we don't hike any further, servicing this debt could be the cause of the next financial crisis.
We agree, and we really like him. We like his thoughts. And yes, it could be. It could be a trigger. We don't know what the trigger is going to be, but we do know something is going to trigger. And this is the more likely one, is the debt, servicing the debt.
Okay, so of course, investors want to know what they should do in this environment. Now, you have said in your latest forecast that you are pulling out of the equity market, that you're looking for an opportunity to sell, to take some profits off the table. So break down that strategy for us.
Well, the thing is that the rise in rates so far hasn't hurt the stock market that bad, but it is beginning to put downward pressure on stocks. So if the Fed takes a break, or rates take a break, come down a little bit, we would use that. That would be positive for stocks. Stocks are very happy when rates go down. And on any rebound strength, we would lighten up on stocks if you are heavily into the stock market.
Well, we have seen a bit of a rebound in the market, staying with that point, following this move from
But further.
Are you using that to offload?
Not yet. No, because we think it'll rebound a little more.
I think it's going to be a few months. Several months.
There's still some upside left in the S&P 500 in the market.
Yes, we think that this bounce could go further in order to exit.
When you say exit, which sectors in particular are you exiting, and which equity sectors are you staying in?
Like we would probably exit the transportations and industrials in general. Like we still like certain sectors, we'll be very selective. Like we like the energy sector, certain parts of the energy. And we may be going into AI as maybe a small position. But there are sectors like the gold shares, and so there are sectors that we will stay in or go into, but not be in your common stock that moves the market.
So let's recap. What are you pulling out of? Which sectors, maybe even which shares in particular, are you pulling out of when you see the opportunity to sell?
Well, right now what we have are ETFs. So we'll talk ETFs like the transportations and the Dow Industrials and the S&P 500.
Okay.
And the S&P pretty much is the NASDAQ and in many ways. So, and we have the NASDAQ, so we may pull out of that too. Or maybe we'll leave it. We'll have to see how it goes. But yes, those are the ones we have.
How much of a upside move do you think is left percentage-wise in the S&P?
Well, we think it's just getting started in a rebound. And everything's just starting. It just started to rise in a megatrend, and this downward correction within the megatrend is just starting. So it sounds like they both have just started at the same time, but they have.
Wait, you said the downward correction is starting, but you're saying there's still a bump up in
in the
markets.
future. Because when we talk about the mega trend, we're looking at decades, a decade trend. And we're talking about the cooling for right now, we're looking at months. So these months ahead is when we think it's time to revalue your portfolio. We recommend that to investors, to reevaluate your portfolio. If you believe, like we do, that interest rates are going to continue up as the years go on, and maybe it won't be till the second half of next year. We don't know, but we know that at some point they're going to be having a renewed rise.
Right, but in the interim, and I get
Yes,
that this
exactly.
is a mega trend, in the interim and more of the short term, Marianne, even though we've seen a bump in the equity markets, you're still not offloading some of these equities in the sectors that you think are most likely to correct. You still think that there's a little bit of resilience and strength left in the
Yes,
equity
yes.
markets?
And that could be, last for a couple months.
Yes.
And it could be, add another 10% or something like that.
I think there's another 10% left in equity markets.
There could be. So that's what we're.
Yeah.
Is there a moment that you're looking for? Is there a catalyst that signals to you, all right, now it's time to sell?
Yes, we use a lot of our own technical indicators.
So you're looking at the charts, technical
Yes.
analysis. So
When,
what is
when
like?
we see that it's overbought, it's gone too far, like on a bounce up, and knowing that we will be moving toward the exit, so we'll be quick to move when we think it's time.
So is there a resistance line that you're seeing, like let's say for the S&P 500?
No, not necessarily. We just, it's more the indicators, the movements. If it gets up to a new high, short-term high, that would be a good sign. If it doesn't make it and it's getting, tired looking.
Well, the whole market, as we look at all of it together, it'll start telling us it's time to exit. And time to exit maybe just lower some positions. It doesn't mean you have to go all out. Mm-hmm. So that's what we'll be doing.
Okay, I want to get back to your general portfolio and your thoughts on gold and silver as well, of course. But before we do that, it's interesting that some of the biggest players are taking some profits off the table. Marianne, JP Morgan CEO Jamie Dimon, he has just announced, according to an SEC filing, that he's selling 1 million shares starting next year. That's, again, according to a regulatory filing. Dimon and his family currently hold about 8.6 million shares of JP Morgan. In a statement in the filing, he says that Mr. Dimon continues to believe the company's prospects are very strong and his stake in the company will remain very significant, and it will, but he is still selling 1 million shares. It comes at a time when Fed Chair Jerome Powell is trying to assure us that the banking sector is still sound and resilient. Let's keep in mind that earlier this year, we had 2 of the 3 largest bank failures in U.S. history.
Yeah.
So what do you make of this move by Jamie Dimon, Marianne?
I think he's probably feeling the same, that the stock market is near a top, a significant top. It may or may not have a significant rebound before it, if you want to think of it as rolling over, and it's tired. It's the bull has been long enough, and I think he probably sees that, feels it, knows it, and he wants to lighten up.
And he probably sees less people buying, not as many customers as before in the bank itself.
Maybe he has a really big thing in his personal life he wants to finance. Who knows? But
But the fact that he does it now is an interesting thing.
Definitely, raising some eyebrows. And this is the same man, by the way, who also said recently that this may be the most dangerous time the world has seen.
Exactly.
He's fearful.
Yeah.
Mm-hmm. Like many people are.
So let's talk about that, because we do seem to have a real high level of risk on so many fronts, right? Obviously, we've got the U.S. economy, as we discussed, interest rates, unprecedented levels of debt, national debt, $33.5 trillion servicing that debt. We have the war in Russia and Ukraine, and obviously the impact that that's had on the commodity markets. Now we've got the war between Israel and Hamas, which is another big geopolitical escalator, and we don't know how that one plays out. I mean, the best of the worst case scenarios here is that it stays contained between Israel
Right.
and Hamas. So when you look at this big, macroeconomic picture, what is the move? What is the move in terms of wealth preservation? How are you adjusting your portfolio according to that?
Well, definitely gold is one of them, because in fact, gold's been rising on that very thing, safe haven, and that's where it's touching and getting close to the record highs. In fact, it hit a record high in euro terms this week, but that's why it's been kind of rising on its own. It's the safe haven of choice today. But it used to be bonds, dollar, and gold, but now it's the bonds fell off the wagon, and we think the dollar is moving into number 2 place as a safe haven, but it's still there, and gold is going to shine. And that's people. Governments already know this. The central banks know this, how much they're buying, and they're buying a lot. And it's the investor that's going to start buying more. And when they feel, what do I have for safety? And really, the only safety is gold in uncertain times. It always has been. And so we think that's definitely one that in this readjusting your portfolio, we think that should definitely be considered for most people to have some, and silver too. And then we wouldn't have bonds.
You would not have bonds.
No.
Not even treasuries that are yielding 5%.
Oh, T-bills, yeah.
Oh, okay. So just not corporate bonds is what you're saying.
No, government bonds, no, but T-bills don't have a bond under it. So that's great at 5%. And we've been telling people, that's a great thing to have. And roll over 3 months.
T-bill and chill, as the expression goes, right?
Okay, you already know that, T-bill and chill. But yeah, and roll over 3 months. Keep rolling it over. And until, I don't know if they're going to come down a bit, but they seem to be pretty happy about 5%. And so that we would do for sure. But no bonds themselves. Even if they're going to have a little uptick now because they're so bombed out, we still wouldn't, unless you're really a trader, we wouldn't buy that. And we wouldn't buy the stock market now. We'd wait to see the rebound and how it turns out.
Okay.
And so you kind of have slim pickings right now of, we like energy though.
Yeah.
Definitely energy. And we recommend uranium. We like that. We think that has an open space like oil does, and oil is definitely benefiting from the Middle East tension. And that will probably continue to keep it up.
It's surprising that oil hasn't moved that dramatically, though, on Middle East tensions, considering the potential for a real catastrophic situation unfolding. Keeping in mind that Iran, which has been the proxy of the terrorist group Hamas and Hezbollah, and has been saber-rattling, making statements. It's usual death to America, death to Israel, but it seems to have stepped up that rhetoric, right? And there have been attacks from other Iranian proxies on some U.S. bases in Syria and in Iraq. And of significance is, of course, the Strait of Hormuz, which in the past Iran has tried to block. And 20% of the world's global energy supply passes through the Strait of Hormuz. Marianne, to me, it's surprising that this hasn't been reflected in the oil markets yet.
Yeah, it is surprising. It's gone up, but not as much as you would think, but we think it's coming. And hopefully this is not going to potentially turn into a big, like a bombshell in the Middle East that escalates. But there's straws in the wind that you just mentioned, that it may, very well could. And then I think you could see oil really take off.
So just oil markets not factoring that as a high or a medium probability, even though the World Bank has cautioned that we could see oil at $150 a barrel if things escalate. And we're all hoping and praying that they do not escalate for several reasons.
Of course.
But it's just surprising that hasn't been factored. And again, I want to focus a little bit more on gold because we have these geopolitical tensions. We've also got, as we just discussed, inflation that is not going to be tamed. Is it surprising that gold, hasn't done better? And as Pamela mentioned, central banks buying gold. The World Gold Council latest report says that looks like 2023 is on record to surpass 2022 in terms of record-breaking gold purchases from central banks. And gold, not really that responsive to this news. I mean, breached above 2,000 a bit, but last we checked, 1,982 per ounce. What do you make of that? What's holding gold back here?
Well, I think gold, similar to oil, it's holding near the highs. It's been firm at these levels, and based on several factors that you mentioned, the geopolitical tension, the economic pressure, the central banks buying like mad. There's many factors that are telling us that gold is ready to go. And once it breaks out into a new high, and it could be because of something that happens in the Middle East, it could be higher inflation numbers, it could be any number of things, but something will trigger, and we think then it'll really take off to much higher levels.
Do you have a price forecast for gold for the next year? Let's say end of 2024, we'll put it out there.
Oh, we haven't thought that far.
Or where have you thought to? Let's go end of 2023. We'll bring it a little nearer term to start off with.
Well, no, we think it has the potential to, once it takes off, and really, depending on what's going on, of course, but it has the potential to double from current levels. And I'm not saying that'll happen next year. It could be a few years down the road, but it could really, get up to 3,000 in pretty short order, depending on, let's say there is a big escalation in the Middle East. Something like that. You didn't mention China, but there's growing tensions, subtle, but they're there with China as well. So there's a lot of little, they're not little, but a lot of hot spots.
Well, Nouriel Roubini, Dr. Doom, renowned economics professor, he has a tail risk, which he says markets are dismissing, says it's a tail risk, but if this conflict escalates and China watches this and sees the U.S. potentially embroiled in two wars and two fronts, may seize the opportunity to make a move into Taiwan.
And that's scary. And China has been is the largest producer of gold, and it's also the largest buyer of gold in the world. So they're really hoarding gold a lot, and you have to wonder why so much.
Well, there was some speculation earlier this year, Pamela, that the reason central banks were buying gold, and especially the BRICS nations, that they were planning on launching some gold-backed common currency. We had the meeting in South Africa come and go. That notion was dismissed. They said that they're not looking at it. They're not even planning on it. But they did say that they're encouraging trade with their own currencies amongst member countries.
Yes.
Is this idea of a gold-backed BRICS currency, Marianne, still on the horizon?
I think it could be, yes. I think it's a possibility. And again, just the fact that so many central banks are, getting out of the dollar, adding their gold by leaps and bounds, as you said, another record year. These are all things that makes you wonder, what do they know that we don't know? And so,
I think investors have to understand that that's what they want, because I think with the market the stock market had been so overwhelming for so many years, and that it's still hard for them to kind of get away from that, the paper money.
Let's talk a little bit about gold and silver, because you have a presentation at this conference, which you've been attending since 1983, you said?
82, actually.
1982, okay. 6 reasons to buy gold and silver now. What are they?
Well, one is the number one is the interest rates, and but the reason is because we think that inflation is going to go with the interest rate rise, because they're not going to be able to contain it, and therefore gold rises in that environment very well, like it did in the 70s. So this is to be seen, but we think this interest rate change is a very bullish tick for the one important thing for gold to rise, and silver. And then the next one would be the dollar. The dollar doesn't necessarily have to collapse, because they move opposite. Gold and the dollar move opposite, and they can move it together at times. It's just the major trends. See, we were focusing on the major trends today, and the major trend says they move opposite, and it looks like the dollar will just kind of maybe not fall, maybe it will, or maybe it'll just become lifeless and go sideways. That's probably what the government would want. And so this is what we say is moving into number 2, because gold is looking a lot more in need. More and more, it's going to become more of a need for people and a desire to have. And the next was with the sixth reason, then central bank buying, how they're buying the biggest records since 1967. This is like a big change for them. They never have bought this much. So what are they fearing? They feel this insecurity. They don't feel that they can trust many countries, and this is where all the divisions coming into. So that is bullish for gold, because they used to be net sellers, or they weren't buying at all. They weren't needing it. Now they do. They really want it for their security in their own country.
Yeah.
And so that was another biggie for gold bull market. And then we talk about, you can continue.
We're at number 4.
Yeah, we're at number 4, because she took over at number 4.
What we've just discussed about the economic uncertainty making people nervous, and the more uncertain things become, the more people want to turn to gold as the traditional safe haven, and then silver goes along for the ride. But and then the geopolitical uncertainty, put that on top, and then on top of that, the 6th reason is the technical. The technicals on gold and silver both look very, very bullish, like they're ready to take off. So you kind of put it all together, and it looks very good for gold.
And we've done many studies on gold for all these years, and we just have them in there. They're really well, and they continue to tell you the same thing. It's super interesting. And one is the big picture we have. It's called the gold is very cyclical. It's very cyclical, and last November was an important low, and it's now proving to be that it was. But we already saw that coming in every 7 or 8 years, there's a low, and this was the last one. And so after that low, it goes into a major rise, and this has been going on since the late 60s. And so this is also telling us that the market's going up, say from here to 2026, 27.
So I get the gold argument, but Marianne, why does silver go along for the ride? Because silver, heavy industrial use as well, right? So if we have economic slowdown, if we have a recession, that would potentially mean less demand for silver. Why does silver come along for?
Well, silver is, as you say, it's used in industry, but it's also a precious metal.
Yeah.
So the slowdown in industry would put a drag on it. But if gold is soaring, silver tends to follow. And when it does take off, following gold, it usually surpasses gold and becomes stronger. In every bull market, silver has outperformed. So it does. It just does. And gold and silver shares as well will do very well.
Go ahead.
I just wanted to add something about if the resource sector starts rising, like we suspect it will eventually follow gold, because that's all the metals of in the commodity world. If we see copper starting to rise and gold's rising, you can bet silver will really take off.
Why would copper rise on those same reasons? Again, copper industrial use.
No, I'm saying when and if copper starts rising, which we feel it's just a matter of time before it rises. And that's the kind of the leader of the resource world as we see it. As they call it, Dr. Copper, because that one's one.
Surely copper reflects more about economic strength and demand. So can we have a global slowdown and a global recession?
Well, this is what's to be seen. Why would the resource sector rise? And if it doesn't, then silver could stay muted for a while longer. But it'll end up eventually.
Because if we do have, this environment of higher interest rates, surely that would slow down economic activity, I would think, because things are harder to finance. And that in a way drags down copper, because industrial growth, I would imagine, is slowing down.
It depends on the green energy movement, because they're all into copper and silver, and a lot of the base metals are going to be used in the green energy movement, and uranium is in there too. So that could be the one that causes the demand. There's going to be some area that's going to cause demand. It's not really going to be the traditional manufacturing that we see. So we'll see. It hasn't happened yet.
What also hasn't happened yet, much to the dismay of many gold investors, is we haven't seen the gold miners really catch up to the gold price.
It's like silver. They both are similar. They look very similar.
Why is that, Marianne? What is happening there? Broadly speaking, and I'm going to group them all into a category, and obviously there's some have performed well and some haven't.
But again, they lag, and silver lags. And so I think they're just kind of biding their time, waiting for gold to break out to a new high. I think once we see gold's next up move, which will be into new high territory, then you'll see those shares really take off, and silver too. And when they take off, they really take off. So it's just kind of the way they work.
Pam, are there any miners that you're looking at as buying opportunities right now?
Yes, we like Agnico Eagle. It's always been one of our favorites over the years. It's AEM. And we like Royal Gold. We like the royalty companies, like Franco-Nevada too. And we like Barrick Gold and Wheaton Precious Metals. And we have some others in the stable, but those are the highlights.
Okay. So you're sticking with those even when you have the position to offload some of the equities that you're looking for?
Well, they haven't been moving with the equities.
Right, but you said that we're looking for the market to rise a little bit, and then you're offloading some of your positions, but you're going to stick to keep the gold miners.
Yeah. Well, yes, because they aren't really the traditional stock market. Okay. Like we're more into getting rid of the traditional stock market.
Right. So as we start to wrap up here, we're talking a lot about gold. Digital gold, as many call it, Bitcoin. I know you have dabbled in that a little bit, or you're looking at the Bitcoin charts, but what's interesting is that we've had Stanley Druckenmiller recently come out and say, and we know that he's very much a fan of gold. He's come out and said recently that he thinks that he missed out on the Bitcoin trend, but that he would, get back. He would have gotten into it, and he sees room for Bitcoin to still rally. Saying that he thinks that the youth of today are seeing it as a store value asset. I'm looking for his exact quote over here in my notes. But trust me when I say Stanley Druckenmiller has been very much a proponent of Bitcoin these days, or at least saying that there is room to get into it. What are your thoughts?
Well, actually, just in this past few months, we've been seeing a renewed rise in Bitcoin for the first time in quite a while. And that's sparking a lot of interest because you get a lot of percentage gains out of Bitcoin. No, I think it's becoming a comfortable market, because before it was like the Old West, the Wild West. You feel like, oh man, this is, there's no restrictions, there's no nothing. It was kind of like just jump in, like jump into an empty hole. But now I think it's more respected, and it's moving more with the markets too. Before it was just kind of doing its thing because it was just coming out of nothing. And but in ever since it hit 20,000, that was it's 2017, there became a change in the excitement of the huge rises. Not to say it got up to 69, but it did when it broke. But it's now holding its 20. So it went to 20, came down to 20. It kind of reminds me of the oil market in that sense, the 40 level and so yes, I think if you're buying it at 20,000, 21 right now.
It was at 34 at the moment.
Oh, okay.
34, 35.
Let's see, it rose that much from that point.
Yeah, that's been up 100% plus year to date. What Stanley Druckenmiller said, now that I have the quote, I'm 76 years old, I own gold. I was surprised that Bitcoin got going, but it's clear that young people look at it as a store of value because it's a lot easier to do stuff with. The young people have all the money, so I like them both, Bitcoin and gold.
Mm-hmm. Well, I would agree with that. Why would you want one and not the other? It doesn't make sense to us. So yeah, you would like Bitcoin because it's Bitcoin, and you would like gold because it's gold. And I would like both of them too. We have not bought Bitcoin, but it's something we look at. We saw that renewed rise starting at the time, a month ago or two. And we thought, oh, that's going to be interesting. I'm real interested in watching it. but we might buy some because now they have ETFs, which makes it comfortable. Because to buy Bitcoin it's much easier to buy a ETF.
Yes, it's a barrier to entry can be a bit complicated to buy Bitcoin as a retail investor, and there is potential that the BlackRock spot Bitcoin ETF may get approved. Hasn't been approved yet, but BlackRock has a pretty solid track record of getting its ETF applications approved. So maybe Larry Fink over there knows something. A couple of other big players like Fidelity and Vanguard, as well as others, have jumped into the spot Bitcoin ETF market. So that potentially could be a boon for that. As we wrap up, just as a recap here, Marianne, if you're allocating a portfolio right now, how are you dividing it in terms of percentage? What are you allocating?
We have a very high percentage in gold, silver, and their shares.
Is that more than the traditional 10%?
Oh, yeah. 60.
60% gold and silver.
Yeah, that includes also
uranium
resources.
and energy. And
metals related. And then right now we
energy.
have 20% of the stock market, which we're looking to get out of, ease out on a rebound. And then we have cash in US dollars and a little bit of currencies, but primarily US dollars in T-bills, 90-day T-bills. We think that's a good place to be for just parking your cash right now.
So 60% allocation, though, let's just focus on that, to gold, silver, uranium, to gold and silver, both physical gold and silver miners.
Yes. So there's a lot of that, right.
Right. The shares.
Yeah.
Uranium, an energy ETF, and some resource shares.
Mm-hmm. And those are hanging on to even as we enter this mega trend.
Yes. Well, for the time being, for sure.
No, it doesn't mean we might unload in this readjustment time.
Right.
But we see this coming up in the next even 6 months. It might be 4 months. We don't know. But that's when we look forward to readjusting portfolios, and we think that's a good thing for people to do.
All right. Final thoughts here, Pamela. As we said, you've been coming to this conference since 1982, right? One of the longest running gatherings of investors. What is different this year, if anything?
As far as the mood?
As far as the mood, as far as the sentiment, what is your takeaway from this year's conference so far?
People are more fearful.
More fearful.
Mm-hmm. People are feeling insecure and wanting to know what to do for next year. I think they feel more fearful this year than the last several years.
Wow. All right. Well, Warren Buffett says be greedy when others are fearful, right? And be fearful when others are greedy.
Well, yes. But is this fearful? I don't know.
Okay.
Well, I guess he was the first one to buy the stock market after the crash.
So, yeah. Marianne, final thoughts. We know that there's a lot of doom and gloom potentially on the horizon. Do you have a positive note for us to end with?
I do.
Yeah.
I mean, I think one is to know what's going on, and like Pam was saying, people, you could see that they're uncertain and fearful, but if you start to, we were just talking to a young couple, and they're here to try to learn all they can because they want to understand it and then make money from it, invest accordingly. So, I mean, not that you want to, you want things to be positive for you, for everyone, but if people are, for example, if stocks go officially turn bearish and people just hang on because they believe interest rates are eventually going to come back down, for example, that's just one example. But then no, you want to go with the flow, go with what's happening. And so I think at a conference like this, you do hear a lot of different opinions, but if you get some good ideas like this couple we were talking to by chance this morning, then it's good. It's positive. Stay very, especially
Knowledge
now.
is power. Stay informed, and that's what we hope to do on Kitco News. We hope to give our viewers a wide range of perspectives and ideas, and help them make up their own minds as to what the best way to go is. Well, thank you so much for sharing your thoughts with us. I look forward to seeing the next edition of the Aden Forecast. Thank you so much, Pamela and Marianne Aden. Appreciate it.
Thank you.
Thank you very much.
And as always, thank you for watching Kitco News. Stay tuned for our continued coverage of the New Orleans Investment Conference. From me, Michelle Makori, and the rest of the Kitco team, we'll see you soon.
Kitco News special coverage of the New Orleans Investment Conference is brought to you by Discovery Group.